Right now, the RBA just hiked rates to 4.1%. Inflation is squeezing every household in Australia, and most people are sitting on the sidelines, watching their savings lose value every single month. But here's the thing. The people who start investing during uncertain times like this are the ones who build real wealth over the next 10, 20, 30 years. And today, I'm going to show you exactly how to do it, step by step, even if you've never invested a single dollar in your life. Let's get something straight. Investing is not gambling. It's not picking the next hot stock your mate told you about at a barbecue. Investing, at its core, is putting your money into assets that grow over time. And in Australia, we have some of the best tools in the world to do that. Tools most people completely ignore. So here's where we start. Before you put $1 into the market, you need an emergency fund. I'm talking 3 to 6 months of your living expenses sitting in a high-interest savings account. Right now, with rates at 4.1%, savings accounts are actually paying decent returns, some around 5% or more. That money is your safety net. It means if something goes wrong, you're not forced to pull your investments out at the worst possible time. Once that's in place, the next thing you want to look at is your superannuation. Most Australians completely ignore their super, and that's a massive mistake. Your super is already being invested for you. Your employer is contributing 11.5% of your salary right now, and from July 1st this year, that jumps to 12%. But here's the key. You get to choose how it's invested. Log into your super fund today and check which investment option you're in. If you're young, you probably want a high-growth option. The difference between a conservative option and a high-growth option over 30 years could be hundreds of thousands of dollars. It costs you nothing to switch. It takes 5 minutes. And it could be the single best financial move you make this year. There's another super change coming that you need to know about. Starting July 1st, 2026, Payday Super kicks in. That means your employer must pay your super contributions on the same day as your wages, not quarterly like before. This is huge because your money hits the market faster, which means more time compounding. And if your employer isn't paying on time, you'll know immediately, instead of waiting months to find out. Keep an eye on your super account after July to make sure your employer is doing the right thing. Now, let's talk about actually investing your own money outside of super. And the simplest, most effective way to do that in Australia right now is through ETFs, exchange-traded funds. An ETF is basically a basket of investments bundled into one package that you can buy on the ASX, just like a regular share. Instead of trying to pick individual winners, you own a slice of hundreds or even thousands of companies in one trade. Let me give you a real example. VAS, the Vanguard Australian Shares Index ETF, tracks the top 300 companies in Australia. We're talking BHP, Commonwealth Bank, CSL, Woolworths, the biggest names on the ASX. It has over $24 billion in assets, and the management fee is just 0.07% per year. That means for every $10,000 you invest, you pay $7 in fees. Compare that to an actively managed fund charging 1% to 2%, and you can see why ETFs are winning. Now, if you want international exposure, which I absolutely think you should have, look at VGS, the Vanguard MSCI Index International Shares ETF. This gives you access to over 1,400 companies across developed markets around the world, including Apple, Microsoft, Nvidia, and Amazon. VGS was actually the #1 ETF by inflows in January this year, pulling in $361 million in a single month. Australians are flooding into this fund because they understand that diversifying globally is how you protect and grow your wealth long-term. And if you specifically want exposure to the US market, IVV, the iShares S&P 500 ETF, tracks the 500 largest companies in America. Over the past year, it's delivered total returns of roughly 9.34%. You can buy all three of these ETFs on the ASX through any Australian broker. Speaking of brokers, you need a platform to actually buy these ETFs. And in 2026, the options for beginners are better than ever. BetaShares Direct offers $0 brokerage on all ASX-traded ETFs and over 500 shares. They also have an auto-invest feature, so you can set up regular contributions without lifting a finger. CMC Invest gives you $0 brokerage on your first trade every day. Perler charges $6.50 per trade, but is built specifically for long-term investors with automatic investing tools. And Stake charges a flat $3 per trade. Any of these will get the job done. Pick one, sign up, and you can be investing within the hour. So here's a simple strategy you can start with today using $500 a month. Put roughly 40% into VAS for Australian exposure, another 40% into VGS for international diversification, and the remaining 20% into a bond ETF, or keep it in a high-interest savings account as a buffer. Then set that up to auto-invest every single payday. No thinking. You adjust the amounts to fit your budget, but the structure stays the same. Even $100 a month following this split will put you ahead of most Australians who never invest at all. This strategy works because of something called dollar-cost averaging. When prices drop, your regular investment buys more units. When prices rise, your existing units are worth more. Over time, this smooths out all the ups and downs and lets compound interest do its work. Now, let me address the thing that stops most people: fear. You'll hear people say the market is too high, or a crash is coming, or it's not the right time. Here's the truth. Nobody can consistently predict what the market will do in the short term. But every single 20-year period in Australian stock market history has delivered positive returns. The risk is not investing. The risk is waiting on the sidelines while inflation eats your purchasing power alive. You don't need to be rich to start investing. You don't need to understand everything perfectly. You just need to start. Open a brokerage account, buy your first ETF, set up auto-invest, and let time do the heavy lifting for you. If you found this helpful, hit that subscribe button and the notification bell so you don't miss the next one. Thanks for watching, and I'll see you in the next one.